Greetings, everybody. Welcome to Liberty Call. Today is Thursday, September 14, 2023. Hope everybody's having a fantastical day out there. You can see my buddy Jake back here. He is super excited for the financial news we're going to talk about. Seems like just looking at the charts, markets were in much better mood today, even though the inflation data that came out was not real positive from an inflationary standpoint. But, we shall see where things go. Anyways, if it's your first time watching the Liberty Call, I'm glad you're here. Thank you very much. If you could, give me some thumbs up, like, share, subscribes, follows, and press that notification bell so you know when I go live. All right, let's go ahead and jump into the numbers for today. Dow Jones was up 0.96%, 333 points, closed at 34,908. S&P 500 was up 0.84%, closed at 4505. NASDAQ was up 0.81%, closed at 13,926. So most these three major indexes are up basically, 80% or 0.8 to 1%. All right, the VIX was down 4 3/4 today. It's at 1284. Canada was up 1.42. Brazil was up 1.1%, and Mexico was up 0.13. So kind of the laggard here in the Americas. Over in Western Europe, Germany was up 0.97, UK was up 1.95%, France was up 1.19, the Netherlands up 1.3%, Spain up 1 1/3, Italy up 1.37, Switzerland up 1.11, and Portugal up 1.54. Russian exchanges were both in the red today. MOEX down 0.28, the RTSI down 1.2%. And the Asian markets, starting out with Japan, it was the Nikkei was up 1.52. Australia was up 0.46. New Zealand down 0.67. In China, the Shanghai was up 0.11. The Shenzhen Component down 0.57. The China A50 up 0.08. TJ Shanghai up 0.03. Hang Seng up 0.24. And the Taiwan weighted up 0.05% for the day. So, like I said, lots of green on the screen today, but, tomorrow's a new day. And, I don't think things are getting any better as far as, inflation and things like that. But, we'll see. All right, market recap. Stocks are rising after Arm IPO as investors shrug off inflation data. So, no big deal. U.S. stocks experienced a mixed day as they initially rose on stronger than expected retail sales, reflecting the resilience of the economy despite hotter than expected inflation data. The three major Wall Street indices saw some volatility as investors processed the August consumer price report. In August, U.S. consumer prices recorded their most significant increase in 14 months, driven by rising gasoline costs. However, the annual rise in underlying inflation was the smallest in nearly 2 years, providing some mixed goals on the inflation front. Investors were keenly watching these inflation figures as they could influence the Federal Reserve's decision on interest rates next week. While the U.S. Central Bank is widely expected to maintain borrowing costs within a range of 5.25% to 5.5% at its upcoming meeting, the recent fluctuations in inflation data have created uncertainty regarding potential rate hikes in November or December. Additionally, inflation data emerged with the producer price index for August beating expectations by rising 1.6% on an annualized basis and 0.7% from July. Retail sales also surpassed estimates, increasing by 0.6% compared to expectations for a 0.2% rise from the previous month. Furthermore, the number of Americans seeking unemployment benefits fell to 220,000, coming in lower than anticipated. Arm Holdings, a British chip designer, made a strong debut on the U.S. stock market with shares rising 17.5%. The company priced its initial public offering at $51 per share, achieving a valuation of $54.5 billion. The IPO success was driven by robust demand, with the stock oversubscribed more than 12 times. Wow. Looking ahead, quarterly earnings reports from companies like builder Lennar and software firm Adobe Systems were expected after the market closed. AMC Entertainment Holdings also made headlines as it completed the sale of 40 million shares, raising $325 million. In the energy sector, oil prices rose despite crude stockpiles increasing by 4 million barrels last week. The International Energy Agency and the Organization of Petroleum exporting countries both maintained their expectations for strong oil demand growth, keeping confidence in the oil market's outlook. Overall, the market's reaction was mixed, with investors navigating through economic data and corporate developments while keeping a close eye on the Fed's next moves regarding interest rates in the face of inflationary pressures. So it's kind of a good news, bad news situation. It's the inflation's still running hotter than we like, which, in my opinion, would lead me to believe that the Fed might raise rates next month. But I think they will definitely, just in my personal opinion, I think there will be at least one rate hike before the end of the year, maybe two. I don't know. All right. Next up, I got here, U.S. retail sales beat expectations as Americans pay more for gas. All right. U.S. retail sales for August outperformed expectations, primarily driven by a surge in gasoline prices, which boosted receipts at service stations. Despite the positive report, the underlying trend in consumer spending on goods indicated a slowdown as Americans grappled with higher inflation and borrowing costs. The Commerce Department report showed a 0.6% increase in retail sales for August, exceeding economists' expectations of a 0.2% gain. However, July's data was revised lower to show a 0.5% advance instead of the initially reported 0.7%. Retail sales figures do not account for inflation and indicated a 2.5% year-on-year increase. Gasoline stations experienced a significant surge in sales, rising 5.2% after a modest 0.1% gain in July. This spike was driven by soaring gasoline prices, which peaked at $3.984 per gallon in August, the highest level this year. Excluding gas station sales, retail sales increased by a more modest 0.2%. While higher gas prices contributed to producer inflation in August, underlying inflationary pressures appeared to be moderating. Portfolio management fees increased at a slower pace, and airline fares did not match the surge seen in August's consumer price data. The Labor Department also reported a slight increase in new applications for unemployment benefits, suggesting that the economy is maintaining its strength. This data is seen as having no immediate impact on monetary policy, with the Federal Reserve expected to keep interest rates unchanged in the near term. The value of sales of motor dealerships increased by 0.3%, while online sales remained unchanged after a 1.5% acceleration in July, partly due to Amazon's Prime Day promotion and back-to-school shopping in July. Sales at furniture stores dropped by 1%, while electronics and appliance store sales increased by 0.7%. Clothing stores sales saw a 0.9% rise, and department store receipts were up. Sales at food services and drinking places, considered a key indicator of household finances, increased by 0.3%. Despite growing concerns about rising inflation and borrowing costs, the report suggests solid growth in overall consumer spending in this quarter, driven by spending on services like concerts, movies, and sporting events. The economy continues to exhibit underlying strength, reinforcing the odds of avoiding a recession. That's their theory. Stocks on Wall Street rose following a report, and the dollar gained against a basket of currencies. The U.S. Treasury market showed mixed reactions. However, concerns about the outlook of the consumer spending are emerging, with excess savings accumulated during the pandemic being drawn down and credit card balances rising. Additionally, millions of Americans are set to resume payments on student loans in October, potentially impacting disposable income. Well, what you should have been done if you were one of those student loan borrowers who got 3 years off, you should have been socking away that money into a savings account. That way you have a cash reserve so that when you do start making your student loan payments again, you got extra money set aside. But no, it's just easier to spend it all. I mean, come on. This is America. We don't save. All right. One last article here comes from LouRockwell.com. It's titled 10 Healthcare Ideas for Everyone, written by Lawrence M. Vance. And I didn't write a summary for this. So I'm just going to go ahead and read the article in its entirety. It's rather short. So if I can make the font any bigger, guess not. In addition to perpetually issuing proposals to reform some government agency or program, conservatives are also fond of reforming something in the private sector that is heavily controlled by government. Healthcare reform is a common reform topic. A case in point is James C. Caparetta's recent Real Clear Policy article titled 10 Healthcare Ideas for No One in Particular. Caparetta is a senior fellow and holds the Milton Friedman Chair at the American Enterprise Institute, a right-leaning think tank, quote, where he studies healthcare entitlement programs and fiscal trends in advanced economies, end quote. He spent more than 16 years in public service before joining the AEI. Public service is just a fancy word for welfare recipient. Capriota believes that, quote, what the country needs is a strong presentation of the alternative to a government-managed system, which is one that relies on competition and choice to deliver better results, end quote. He correctly states that the U.S. healthcare system, quote, is best seen as a public-private non-system built upon a haphazard mix of subsidies and regulations adopted at various points in response to idiosyncratic political and historical factors, end quote. He then offers 10 reforms that, quote, would not fix healthcare once and for all, but would deliver tangible improvements, end quote. He divides the reforms into 3 groups: general reforms, Medicare, and coverage. I won't bore you with the reforms and all their details. They are proposed reforms of a deeply flawed system. After all, quote, for no one in particular, end quote, not principles upon which healthcare for everyone in the United States should be based. So here are 10 healthcare ideas for everyone. Number 1, the Constitution does not authorize the federal government to have anything to do with healthcare or health insurance. I've read it. It doesn't. Number 2, the Department of Health and Human Services, National Institutes of Health, Food and Drug Administration, Centers for Disease Control and Prevention, and the Centers for Medicare and Medicaid Services should be eliminated. That probably saves some money too. There is no right to affordable health care. I agree. Number 4, healthcare is a service that can and should be provided on the free market, just like any other service. Number 5, Medicare, Medicaid, and State Children's Health Insurance Program, CHIP, are welfare programs that should be eliminated. It's not my job to pay for your kids. Number 6, it is not the proper role of government to fund or subsidize healthcare services. Number 7, it is not the proper role of government to regulate or mandate healthcare services. Number 8, no American is entitled to healthcare provided at the expense of another American, regardless of how poor, old, sick, or disabled he is. Sorry, Democrats, not my problem. Number 9, no American should be forced to pay for healthcare for any other American. And number 10, healthcare freedom is always preferable to government intervention of any kind. And to finish up, all conservative healthcare reform proposals fall short because they are reform proposals. The problem with healthcare in the United States is not that the system is broken and needs to be fixed by government reforms. The problem is that the government is the government control of the system. Healthcare should be completely separate from the state, just like religion. So that was an interesting little article. So didn't really have a lot of details, but food for thought for liberty-minded people like myself and hopefully you out there. All right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information's there. Hope you have a wonderful evening, and I'll talk to you next time. Adios.